Hello, Ashwin.
How are you?
I do this series of interviews with you to benefit the retail investor. And that category, I mean, those of us who don't have the 5 million US dollars, who get to work with private banks and who get expert advice because we have what we call private banking accounts. So this series of interviews is to help those of us with lesser than that amount of money, so that we have you as our compass to show us the way with your guidance as led by your algorithm. So just to set the record straight, that's why I feel compelled to share your expertise with my friends. Now, a couple of shows ago, you said that this is a time where there's fluctuation, the beginning of the year, right? Yes. Where there's correction, and not to panic, because one has to be quite clear what is a correction and what is a crash. And Correct. To have that compass means not to panic and to be sure-footed enough to, take the bull by the horns, as it were, and stay on the path. Now, I read somewhere, and I'd like you to clarify.
Yes.
The individual investors have been aggressively buying since the January dip. You mentioned that there's going to be this volatility, right? So retail investors, apparently, as I've been reading, have rushed in to buy. And would you, comment on that?
Yes, definitely. As you all can see who are watching this video, on 4th January, in our video, we said that the market will drop in January and not to panic and buy the dip. Okay? And this is exactly what happened.
Yes.
The sad part is this. On 24th January, all the amateur investors, what we call the mom and pop investors, they got worried when the market dropped. The Dow dropped
right.
1,000 over points before lunchtime on 24th Jan, and they cut loss of 1.36 billion.
Right.
So guess what? On 28th January, individual investors started buying the dip. If I was a mom and pop investor, I would be very frustrated. My hard-earned money, I cut loss on 24th January, and on 20th January, people come and buy the dip. I've seen this happen all the time, every year, with amateur investors. And it's very sad because it's a very push and pull thing. They refuse to spend money on professional advice. So I'm sorry, but we can't help them. We can't help them.
Can't help. You can only help those who need or want to be helped.
So let me tell you what happened. Between 28th January and 1st February, as we expected and predicted, retail investors scooped up more than 1.3 billion in equities, okay, according to Vanda Research. This is facts. This is facts. Not me, facts.
Right.
Vanda says that this level ranked above the 70th percentile for the last year. Now, this is what Vanda Research says. Okay, since 28th January, retail investors have been buying into the rally, something we hadn't seen since May and June 2020. This man is called Ben Ohatibia, senior strategist at Vanda Research. He says, now this is what we mentioned in our video as well. Before this report came out, we said in our video that retail investors are buying ETFs. And he says most of the dip buying was concentrated in broad market ETFs. But retail investors did stage a significant increase in single stock purchases. Now,
so how do you think these retail investors knew how to rush in and buy?
No, I mean, we're not saying everybody's stupid, everybody's wrong. They have their own instincts, they have their own bankers. Some bankers tell them something.
So when they
saw depends on your banker, how they hold your hand.
When they saw prices fall, they rush in to buy.
Yes, but let me tell you something else. While the market was dropping, we had one video on ETFs where we said that if the tech sector is dropping, it doesn't mean you throw the baby out of the bath water and say, I'm not going to touch tech stocks. Because we kept on saying during that period, quality tech names. Do not discount tech. Do not say, I don't want to buy tech because the market is dropping. You see, what we're trying to show you here is that Do not let price action make your decisions.
Right.
Understand the company, what kind of company it is, what kind of quality it is. Do not write off something because it's volatile. That is
so you
total
say
rubbish.
flight to quality, as you say.
Yes. So you have to analyze the company very well. You don't say, because the company has dropped 20, 30%, I'm not going to buy the stock. Wrong. Look at Facebook. On the 3rd of February, because of weak earnings and because they spent money on metaverse up to $10 billion, their stock has dropped 25% in a single day on 3rd February. Does that mean Facebook? Does that mean Facebook is a lousy stock? No. Let me show you the proof and the thing. On the 3rd of February at 1 p.m. New York time, Morningstar says that Facebook is undervalued. Listen to this carefully. And it is worth $400 per share. And the current price action is unwarranted. It's exaggerated. See,
so they are
it doesn't mean
so
the normal mom and pop investors say, oh, Facebook has dropped 25%. Oh, we're not going to buy this. Wrong.
So I want to say that with your compass, we are able to pull the camera back and to look at the big picture,
yes.
So that you see the entire landscape. Yes.
You see, so Facebook, I'll give you a free tip now. 1 year from now, free tip. 1 year from now, all of you watching this video will have hoped that you had bought Facebook. Because why we talk like this? Let me tell you why. Metaverse is one thing. Facebook is building the world's fastest artificial intelligence supercomputer. Need I say anymore?
So we are pulling the camera back to look at strategy.
Okay, now let me be objective with you. I'm giving you free advice here.
In, out, in, out.
I'm talking to you as your algo trader advisor. Forget $400 a share. Facebook yesterday went to the low of just below 237 per share. And then it closed above 240. Okay? Forget $400 a share. Facebook will climb to at least $330 a share.
That's a good upside.
That means there's about $80, $90 for you to make. This is not about, oh, the bank is powerful, the bank got a lot of money, so the bank keeps on making money. No. Let me talk to retail investors and tell you this. You can make the same money like the bank, even more. You can be a Warren Buffett in your own field. But to do that, you need to pay for professional advice. We cannot help you if you say you want free advice. I'm sorry, we can't do that. We would love to help you. We would love to hold your hand. But if you say, I can do it myself, it's not worth paying you. I'm sorry.
Like I always say, if you want to get good at tennis, get a coach. If you want to get good at golf, get a coach. If you want to seriously make money, get a coach.
Now, let me show you further evidence. Like I said, on 24th January, the mom and pop investors cut loss of 1.36 billion. And then at 4 o'clock in the afternoon, after they cut loss at 12 noon, the market bounced and created a solid bottom on 24th January. Now, Vanda Research says amateur investors, the mom and pop, are not buying the single stocks they were a year ago. Means this time round, they were not buying. When the market actually starts going up, when the people are actually buying, the mom and pop stops. So mom and pop and the amateur investors get scared and say, we're not touching this market. Can you see? Can you see? It's so sad. When it's time to buy, they don't buy. When it's time to sell, they buy.
It's like going to a place without a roadmap and getting lost.
Yes, and then they say, we lost money. But you will always, I'm not cursing anyone, you will always lose money if you do things like this. First of all, we do not buy stocks when they are going up. Understand this clearly. Jesse, you have been working with us for 5 years. We do not buy stocks when everybody is buying. We buy stocks when everybody is in fear. Why? Number one, we have an algorithm that does data mining and gives us the complete report of the company. So when it comes to facts, we have the facts. For example, Microsoft, we have the facts. We know how much Microsoft is worth, how much Microsoft can make, how much Microsoft can harness, we know. So
the depth of information.
Information. That's what you call data mining. So you see, you're not paying us only for data mining, you're paying us for everything else. So when you have this kind of information and Microsoft goes down $50 a share, Why should I panic? I will buy. People panic because, like Warren Buffett said, you fear risk because you don't know what you're doing.
Yeah. You
You
don't know where
fear
they're
risk.
going.
Retail investors, mom and pop investors fear risk because they have no clue what they're doing. Their actions are led by price. Stock drops 50%, $50. Oh, I don't want to buy it. Facebook drops $80. Oh, I'm scared. I don't want to buy. But if you understood what Facebook is doing, you will buy.
It's a no-brainer, Ashwin.
We're going around circles to say that if you don't hire professional advice, you can never succeed.
Exactly. I mean, you can possibly have lady luck on your side, but not
once
for
or twice or whatever.
A while.
Yeah.
Not sustainable.
It pains me to talk about this because I've seen this happen every year all the time. And let me tell you why the market is happening like this. I'm a hedge fund. I'm holding $20-30 billion of customer money. I'm not going to buy in this market. I want to push the market down first. Look at Netflix. It dropped more than 20% after earnings, which was soft. Just like Facebook. Guess what? Hedge fund came in to buy 3.1 million shares.
Yeah.
See?
Yeah.
They're doing the same thing they're doing. When it's panicking, they're buying. Why are they buying Netflix? Because they understand Netflix as a company. They know what the value of Netflix is. But if you make a decision on Netflix just because it dropped 20%, you will never get anywhere. Now,
so I would say, hang on. I want to keep underscoring, I want to keep repeating that if you really want to do this seriously, get expert advice. You know, we can't do it alone, and we certainly cannot do it shooting blind.
I'm not boasting, but you definitely cannot do it alone because there's so many elements in the decision-making process.
Yeah.
Now, let me tell you why hedge fund is buying 3.1 million shares of Netflix. They're going to spend $17 billion on content. Which streaming company has got that kind of money? Only one.
They're a market maker for sure. So you really
Apple,
want to
Disney,
buy
and Apple, Disney, and Netflix. They have the kind of money. Nobody else has.
Yeah.
So you see what I'm trying to say again is this. If you understand everything about a company, and if the company drops like crazy levels like Facebook or like Netflix, why fear? If you don't know anything, then you fear. I mean, we're trying not to blow our own trumpet here, but you definitely need advice, professional advice.
The short term, like punting or gambling, then it's like in out. But if you're a real true investor, you have temporal control, time.
Let me make this clear. We do not scalp. We have turned down so many clients who insist that we do scalping. We do not scalp. We don't want to scalp. We are position takers. We're not scalpers. We're position takers. And let me tell you something else. The biggest fallacy. Warren Buffett is not a genius, please. Don't say it's a genius. If you had followed our trades, you will be just like Warren Buffett.
He's got control over time and his money.
Yes. So don't say he's a genius. He's not. Warren Buffett can afford to wait. If you can wait 2 years, and if you've got $100,000 US, we can show you what your version of Warren Buffett looks like.
True.
But if you're going to panic every time, and you don't even understand or even plan also how much paper loss you can afford, then that's it. Don't talk about Warren Buffett.
What's your take on leveraging? What's your attitude towards that?
Our benchmark is 20% paper loss at any one time. Means you should be able to sleep properly and say, I'm not worried about 20% paper loss. Sometimes market spills like this correction is overspilled. It can become 30% paper loss.
Right.
But you see, paper
on a big name like Facebook, don't panic.
Don't panic. So you see, there's no actual number in the sand. So if the stock drops 25%, 30%, it's not important. It's not important how much the stock drops by. Listen to this. It's not important. Important is, do you understand the business of this company?
Right.
I repeat, how much the stocks drop is not important.
Yeah.
For you to understand the quality of the company is very important. Because when you understand the quality of the company, you will have the courage to say, this is bullshit. I'm going to buy it. I'm going to buy more if I can afford it.
What do you want to encapsulate for this series, this show for the audience?
We would like to really hold the hand of the retail investor and make them good money. I'm talking about 30% ROI per year. But unfortunately, we cannot give you our hand to hold and give you our assurance because many people say, I don't want to pay for advice. Then we can't help you. Okay? And we're trying to prove to you with all this evidence that
expert advice is necessary.
Yes, like I said just now, amateur investors were not buying stocks when they were supposed to buy. They should be buying now, but not supposed to buy. And guess what? We said this in our video. I want to add this. When the tech stocks were being thrown out, we said they're quality tech names. And amateur investors since 28 January have been buying tech stocks. So what are you going to say now? You look at the market going up and down, you get the market going in a correction, and you say everybody's selling tech stocks. I'm not going to buy tech stocks. Well, how wrong you are. I cannot tell you for business purposes what stocks they were buying. We have a complete list, let me repeat, of what stocks they were buying. And in addition to that, we add value to you because we have, our algo has data for dark pool and as well as options. What are dark pools? When institutions and hedge funds want to buy stocks, they don't go to the normal market like you and me. They go to a private exchange called a dark pool. And we have access to that, meaning at any one time, we know what the big boys are doing. We only charge you 5,000 US a year. Everything else you make is yours to keep. No performance fee, no nothing.
For those of us who don't have the $5 million for private banking, we will need approximately 100,000 US dollars to work with you. And
50 to 100,000, in fact, make it simpler for you, 50 to 100,000.
And the cap is 100,000.
Yes, minimum 50, maximum 100.
Which goes into the client's own bank account in a broking house.
Yes. In an own account in a broking house, we will tell you what to do.
And your fee is 5,000 a year. Then we also need to sign
documents like power of attorney because we need to do things for you while you're sleeping. See, these markets, they move excitingly every night after 1 p.m. New York time. Means after 1 a.m. Asia time.
Okay. That's
when you're sleeping. That's why in the background, we're working for you.
So money in my own account in a broking house, and your fee is 5,000 per year.
Yes.
Okay.
And what's even more interesting is this. Now, for example, Apple is $175 a share. That's a lot of money. Now, using a CFD, what we call a contract for difference, because we understand Apple so well, I'll tell you now, Apple will go to $225 a share. Right now, another free tip for you. So, instead of spending 175 US dollars a share, the contract for difference enables you to only spend $17.50 on Apple per share. Why pay more? If you know Apple is going to go to 225, you can buy per share $17.50. You buy 100 shares or whatever you are comfortable with. This is something that has now come to light because, number one, people always say CFDs are risky. That's because they don't know about the company. They buy a penny stock and it crashes and they lose money. If we know, if our algorithm knows, based on options, dark pool, whatever, that Apple's going to go 225 a share, shouldn't you take advantage and buy $17.50 per share? You can buy whatever you're comfortable with and save so much money in terms of margin up front. CFD is the future, and we are here to redefine the futures of CFD because we have the quality financial intelligence to make you money at only 10% of the cost of the share. And this, I really mean it. It's really mean it. So fools who pay full margin and say, I feel more secure, that's rubbish. Today, our clients, we bought Apple at 146 a share, means they paid $14.60. Now Apple is $75 a share, means it's $17.50. They have made money from $14.60 to $17.50 in 3 months. Apple, and we're still
so they make the difference from 14 to 17. That's what they make.
14.60 to 17.50. That's money, right? Yes. That's 25%. That's 25%. Isn't it good? And look at the margin. It's only 14.60 per share. You can buy 1,000 shares. You can buy 2,000 shares.
It's the same yield.
Yes. So why would you? So we are giving you the bang for your buck. If you have $100,000, imagine how many Apple shares you can buy.
Okay. So what would you like to say as your parting word?
My parting word is this. I'm not boasting. We know something that you do not. Because we've been in the business for 28 years, we have an algorithm that is 75% artificial intelligence. 25% human genius. We have dark pool data. We have options data. We have 24 hours data mining. We know what the banks are doing. We know what the hedge funds are doing. We know what's happening. We know which company is shit and which company is not. So based on this, I must add, our research alone is worth more than 5,000 US. So when you pay 5,000 US for all this, you're getting a package worth at least 10,000 US for 5,000 US.
How do we contact you?
Because of the service to society, we don't charge you any
performance
fee. So all you pay is 5,000 for 1 year. And if you have 100,000 US dollars as committed capital, you can cover your fee in 3 months. We've done it. We've done it. All our last batch of clients, 100,000, we've covered their fees in 3 months. So I don't understand what is the hesitancy to sign up or whatever. I'm not trying to be hardcore here, but because let me put it bluntly, nobody else does what we do, and nobody else does what we do for this kind of price. That's a fact. You can check us out on the internet. Whoever does this.
How do we contact you, Ashwin?
My email is ashwin@ppchk.net. And on WhatsApp, it's bit.ly/algotrader. On Telegram, it's bit.ly/algofactory. And please subscribe to our YouTube channel, bit.ly/algowealth. So there you go.
Thank you so much. And I will be contacting you soon for more shows, yeah? More advice.
Thank you.
Thank you so much.